afternoon. How is everybody? It's Saturday. So today our topic is about tax planning. I know it is a topic some of you felt not necessary, but this 1 hour we really talk about a couple of key points. You don't have to think of it is applying to you or not, but when you hear those terms and the things we're talking about today, and just keep that back in your mind when you grow your business or when you set up your business, and know to ask these questions because they really are important. Just like if you're into tax savings, tax planning is a necessity. If you're not into tax savings, some people's mentality is that, oh well, I'm just gonna run good business, I'm not gonna worry about taxes, whatever I need to pay, I pay, I'm okay with that. So if that is part of your mentality, then obviously planning seems to be unnecessary, right? But I want to say that just like when you are working on the business, you're trying to buy low and sell high, or you try to save your administrative costs and all that stuff, those are the things. It's a business habit. You have it. If you don't care, and then you're just not gonna get into that at all. So let's just get started with our webinar. So I want to introduce to you about the website of our firm, communitycpa.com. You can go onto our website, look into right here. You can see that you can book appointment with me and to ask you specific questions. If you have a list of questions and you accumulating, and when you look online or you go to other professionals or your friend, they give you all kind of different answers. And I want you to group them all together, come in and make appointment with us. Let us really tell you what needs to be done and what is the most appropriate answer for your business. It's not every answer is applying to you as you think it should. Then of course, all our webinars is in this YouTube channel. And if you go to youtube.com, you type in Community CPA, you'll find us. There's more than 1,000 videos, and they're all knowledges, and we cut them into small pieces for you. So nothing too heavy. There's no videos over 60 minutes. So all of them are really concentrated on a topic. For example, tax planning. So if you type into tax planning right here under magnified glasses, you'll find all kind of tax planning webinars we do. If you listen to all of the tax planning webinars we have in our system, you suddenly kind of get understanding of what we're trying to teach here, because there's just so many content in there, right? So let's not waste any time, and we will go to start doing giving you the our slides. So let me see. There you go. Okay. So tax planning for companies. I put in here as a companies just because I want to focus on our small business owners. And of course, tax planning can be done for your individual tax situation. But here we're focused on business. And I myself is the managing partner and the CEO for Community CPA. I am very proud of our team. Without this team, there is no way we can go this far. And this company started in 1998. One person, one client, and from the home, from my house at the time. And then look at today, we grew for the past 20 some years. Right now we have 40 professional staff. We have 3 locations with staff. We have 4 branches, 3 locations with staff. And we're growing. And we're growing not because we just like to grow. It's because the demand on the market, people like you who heard our videos and will come to us. So we're gathering momentum. We're here helping small business to have our own expertise to grow you, because there are times these knowledge are not pertaining to you because you didn't pay a couple $1,000s to get it, right? So people who are doing good businesses like Elon Musk and Bill Gates, they don't worry about professionals because they have professionals as an army around them. But you as a small business owner, just like me, when I started from so long ago, so little, you need professionals around you. And we can be such a qualified professionals that helping you and your business. So here is my first book called Appointment with Ying at 8 a.m. So that book is about how you start a business. I just finished and will publish very soon the second book called Appointment with Ying at 10 a.m. This is the book cover, and you will see that it's about growing the business. Then the third book is about expanding the business, expanding it with different methodologies, methods. And you could say that, well, I know how to expand. I just buy other companies and make it bigger. No, there's other ways to expand your business. So we will explore that in the 2 p.m. book that I am writing right now. Then, of course, my last book is Retire from Your Business. That's at 6 p.m. With that said, and disclaimer, no responsibility, and it's a free webinar. So make sure that you take the knowledge seriously, and do not forget to double check what you're going to use. And if you are going to use one of our talk here, and you want to make sure you check with your attorney, you check with your CPA, or just simply come over to Community CPA and we will take care of you. Now, and this is a chart, this is a thing, this is a cube that we display all the time in our planning session. Just because we want to give the concept to you of when you do your planning, when you want to save taxes, and what are the area do I focus? And there's so many things on the market. You know, when I type into tax saving, man, I got so many, YouTube videos. I don't even know which one to look for. And how should I start? As a small business owner, I just want you to remember this box. There's 3 large areas, very large areas, that you will focus on and decide on who you want to be. Because if you do these steps we talked about, the way you're paying taxes will not kill you. And there are people who couldn't go on with the business because the tax burden was so heavy. They have to borrow money to pay taxes. It is all wrong. It is all backwards. And really, in our system, with IRS or with any other local or state government, the taxes, yes, it is an obligation, but it's not a burden. And if you come here and I felt like taxes is a burden, something is wrong with your setup. So let's look at these things. So we have tax structures. I listed on the bottom of the cube. Then accounting method and a fiscal year. So you might go, well, what does that do to me? And let's go ahead and kind of decide what you see in each sectors, and then you know what to apply to yourself. Tax structures. So what is the popular tax structures in US business system? Just these 5. And I want to say, I'm saying that just these 5, of course it's not only 5, but it is largely the 5, because small business, medium business, largely relying on these entities. Number 1, sole proprietorship. Number 2, LLC, LLP, limited liability company, limited liability partnership, S corporation, small corporation, C corporation, privately held or public corporation, right? Corporation. Not-for-profit is actually the kind of entity that elected to be a certain purpose company, so they're exempted from income tax. We call them not-for-profit corporation because they're exempted from income tax. You may say that, oh, example would be United Way, example, like animal shelter. Those are all nonprofit organizations, right? So now let's look at this chart. This is one of our very famous chart. And I have people who actually took a screenshot of this and would coming into our firm and verify what they're doing with their entity to make sure it's right. So I want to leave it here on the screen, but we talk about things related to this entity. So when you set up your company, that's in my first book, Appointment with Ying at 8 a.m. If you go on Amazon, you're going to find that book and you can buy it because that book actually explains to you how to set up your first company. Say you set up a company, it's an LLC, and you grow the company and you made a $200,000 profit on the LLC. The way you set it up could trigger you to pay more taxes. So the best way is to earn that money, but start moving your LLC into other structure. You see, tax structure has all kind of ways to eliminating unnecessary tax. Of course, you can be a sole proprietor making $6 million net profit. Of course, you can do that. But if you do the $6 million net profit under Schedule C, you are paying a lot more taxes than you're doing that in the S Corp or in the C Corp or even in the nonprofit. So there is a choice that we make, but I want you to make that choice consciously, knowing why. Not just, oh, my attorney told me that I need to be LLC. I'm pretty sure there is a good reason for that. Maybe your risk of business is in such a way that LLC protects your interest okay, or maybe your attorney was worried about you don't have enough money to pay for their consultation and a formation bill, and LLC is the easiest to form and it's cheapest to accomplish. So that could be all kind of reason why you ended up with LLC. But are you going to be there or not is determined by your circumstances. I just kind of want you to know that people paying taxes is according to the rule. If you're a C corporation, now it's a flat rate of 21%. That 21% could trigger you to, could give you a certain amount of tax due because you had $1 million profit. So you pay $210,000 federal taxes because it's a flat rate. But if you make this $1 million under sole proprietorship, not only you pay the top income tax rate, which is 37.5, folks, and plus the additional tax that was imposed by Trump administration, that's another 3.75%. So you're paying roughly about 40, right? And then now, with that, you pay self-employment taxes. So those are additional taxes. If I add those up, you are paying a lot more than 21%. So you will pose question of why do I need to be in this setting, paying so much more taxes than I'm being on the C corporation. But there will be people saying that to you, oh, if you have a C corp, you have a double taxation, so you need to be careful. And what is that double taxation, right? So we want to make sure that you understand what that is before you proceed. So I just want to leave you with the impression. The tax structure is flexible. You can move from one to another, just like the map indicated. You see, the S corporation can be revoked back to C corp, and the C corp on the bottom can be elected to be S corp. And then you look at the LLC. And that one can be elected to be what? S Corp and the C Corp. And you see the line as a K1. When you see the K1 line going through your 1040, you know what that is. You know what that 1040 is. That's just what we call those kind of corporations. Companies are pass-through entities, right? So they're pass-through. And you see your final result of your company accomplishment would be taxed under 1040. And with that said, and whatever you have in the LLC or S Corp is reflected on your 1040, but they are not taxed the same. And LLC, if you're an active member, and you would pay self-employment tax. But if you are C Corp, you walk away from self-employment tax completely, so you don't pay that on the K1 income. And if you look at my 1040 box, it shows you that if you're a single member LLC, you were documenting your income and expenses under Schedule C right now. And why do I know that? Because you file only one tax return. You group all your business income into your 1040 Schedule C. That particular LLC can be elected. Can be elected into S Corp or C Corp or LLC multi-member partnership. You see how that can change? And you can make that change when you do your taxes. That's called a late election, and professionals like us knows how to file the late election, and you can get that done. So you don't have to know the result way before then make the arrangement way ahead of time. You can do your realization at the time you file taxes. You can make the move at the time you are doing your tax. So that's something I want all of you to know. You're not set in stone to be late. It doesn't need to be late. You can do a late election. Then of course you see my lines in the middle of the page. So underneath that is a C Corp and nonprofit. What I am trying to tell you is that the relationship between C Corp to your 1040, that's only two type of relationship in normal business transaction. Number one is the W-2 that the C Corp can issue for you, or the C Corp can pay dividend to you, right? And if you organize the nonprofit, then of course, if you work for the nonprofit can pay you W-2 income, reimburse you for your expenses whatsoever, but the nonprofit and C Corp kind of kept away from your 1040. So why it is so important? If you have a business that you failed, and that business is a C Corp, then you only need to file bankruptcy for the C Corp and walk away from the consequences. That is what our prior president, Donald Trump, has been doing. And I don't know now, but he did that before. So he had C corporations, then this went belly up and write it off and bankrupt, but his personal side of things was not affected. He still lives in, Mar-a-Lago, and he's still a millionaire, whatever heir he is, but so he is still have that lifestyle, right? Didn't impact his personal. So with that said, business owners knows how to protect yourself. It is not just form a entity and hear the attorney saying that, oh, this is better because it's prevent business risk. And we need to think bigger. We need to know that if you have an entity, when your finance totally not working, does that relate to you? I actually just got a text from a client because they are getting ready to file to their business rent space. Then there's a lease agreement. She's saying that feels like it has a personal guarantee. Does that mean if I sign this and if business fails, I cannot stop paying the rent. I still have to pay personally because I don't know what that do this page. So obviously, personal guarantee means that if your company went belly up and you personally liable, your 1040 is liable to pay for the rent. So, you always want to keep yourself away from your high risk endeavor, and especially if you're not guaranteed yourself to win the game, you want the business to impact you as little as possible, right? So with that said, structure is a big deal. Structure is a source of reduction for taxes, and the structure also is a source of protection. So just keep that in mind. That is our three things we talked about here, right? The structure. So really care about the structure. And when you talk about structure, tax structure, people knows what you're talking about. Okay? All right. So the next one we want to talk about is actually accounting method. Accounting method. So what is accounting method? When you have a business and you haven't really done your taxes yet, accounting is actually very important because whatever you do in your accounting, that's what you give to your tax people. Am I right? Your tax people will look at your financial statement, knows how to report tax for you. But if you don't put your accounting in the right category, for example, if you're doing R&D tax credit claim and you don't separate your expenses for R&D purposes in accounting, how is your tax preparer would know that this group of expense should be treated differently? They can't, right? Then again, how do you put that entry onto your accounting? Are you just gonna make an Excel spreadsheet and write down everything you spend? If it is R&D related, you'll mark that as R&D. You know what? When your business is small, that is okay. It is not like you have to use sophisticated accounting method. So the most popular accounting method is cash method or accrual method. Those are the two most often. If you are, I know on internet you'll find a lot of knowledge related to that. Just simply know that in your business, you can do cash method, you can do accrual. Especially small businesses, you're not required. You're not required to use any of the method. You can just write a laundry list of your expense. But if you already have a pretty sizable business, when I say pretty sizable, I would say above 2 million. I used to tell people that above 250,000 sales, you are a sizable business. But I know that with the knowledge elevating, with the Excel becoming so popular, most of the business owners I come across knows how to use Excel. I would say that if your business is under 2 million, you want to use Excel to document all your expenses and your income. That's not wrong. You can do it. And you just mark down, but you still need a area or category or a section to track expenses for different purposes, right? So meal entertainment is meal entertainment. Utility is utility. So you need to go through these kind of categories to make sure you're doing it right. So with the accounting method section, and I just want you to know that cash method, what exactly the cash method is, folks. Cash method just means that when the money comes into your bank, you deposit that money, that's your income. Of course, if you deposit your mom's money, she was giving you that to buy a machine so you can continue your business. That's not income, right? That's the money you borrowed. Or if your mom gave that to you, that's your equity. That's not income. But you document all your income so when you receive it. And you document all your expense when you spent it. I mean, spent it means it went out of your bank. So whatever you did, it has happened in between your year, right? From January to December. So within that year, you received it, you spent it, and you documenting that way. That's your cash method. The accrue method is a method that in line with the proper accounting regulation, right? You heard of GAAP standard, you heard about audited financial statement, you heard of those auditors who come to the large company to audit them. When they do stuff like that, they would be in accrual method. Means that if they got a customer saying, I'm going to pay you $2 million for this work, and this income, it is already documented because it's already coming in to the bank. And but the work you do has not done yet, so that's not your income. You see, that's your unearned income. That is your liability. So for our small businesses, sometimes with consulting work is worked that way. We have a consulting company who is our client, and in December, their business cycle is 12 months. So in December, they sign up new clients for the next 12 months. So they got over $1.2 million sign up in the month of December, but none of them were delivered. They're just signing up because they're getting ready for the next year. Are you going to report income for the 1.2 million now in this year, or it is your unearned revenue? You're going to report that income when you performed your job, so it will be next year's income. If you're on cash accounting, you report 1.2 million in this current year because you got it. But if you are in accrual accounting, you don't get it. Even though it is in your bank, I'm sorry, you haven't really placed your service yet. So it is unearned revenue, is liability. So you don't report the 1.2 in current year. So my client came over to me, goes, Ying, I had a really good year. My income literally doubled And because I signed up so many clients, total 1.2 million, the money is already in the bank. So how much tax do I need to pay? So she is under accrual accounting. So my answer would be what? You do not need to pay any taxes for this 1.2 million because that belongs to next year. Are you sure? Can I really do that? Yes, if your accounting method is accrual, you can do that. But if your accounting method is cash, you can't. What if this person came in and she is in cash method? And there is a form you can fill up, Form 3115, to change accounting method. You just have to report to IRS that you need to change accounting method for all kind of reason, right? Not necessarily, oh, I just want to reduce taxes. But that's not wrong. You can just fill up the form and tell IRS that you just want to reduce taxes. IRS just want to know that you change it for economical reason. So that way, and you can just move on with the new accounting method, right? So of course, accounting, like I said, the method is one thing, but to classify all your expenses and documenting your company expenditure is really important. And I want to give you 3 other examples related to the right accounting equals to accurate tax deduction. And I want to make sure that we understand this. Accounting is not useless. A lot of times you will see clients doesn't put values on accounting because they only see the tax result. They don't really know accounting is actually the backbone of the tax result. So they think that bookkeepers should charge very little dollars and they don't do anything and they just give the final number to the tax people. But this final number is so critical. For example, if you want to claim home office and in your accounting record, you would document how much of a home office expenses or how much your home expenses are, then you will use percentage to calculate the cost, right? So that would be documented in your bookkeeping or in your accounting. Then of course there's a work opportunity tax credit. You hear my other webinars about tax credit, and if you get a 5,000 tax credit, that pretty much equals to $100,000 tax deduction. Okay, tax credit offset your tax dollars. And some tax credits are refundable, some are not refundable, and your work opportunity tax credit is refundable. But then of course you will be saying, why does that has anything to do with accounting? Of course it does. Because your accounting book needs to document all the premiums that you paid for your employee. And if you have a cost item called medical insurance premium paid for employee, then we use that total times 50%. Then we can get to I'm thinking this work opportunity credit is a $2,400 per eligible new hire. I was talking a different one. So this work opportunity credit is that if you hire a new person, you hire this person. And this person's salary needs to be documented differently. You need to separate them out to work opportunity tax credit area. So we knew that these people are all the work opportunity credit applicants. They are applicable for that. Each one of them, we can reduce $2,400 taxes for you. So let's say if you need to pay $2,400 taxes this year, but with this claim, you wipe that out. So then we need to document their salary, right? So you want to make an area for salary that you paid to that individual, and that individual qualifies for the opportunity tax credit. Then you just need to know who qualifies. That is something that as an accountant, you kind of need to know a little bit of what the tax world is. So you will set up the items and to track them. But of course, some of our clients don't know anything about it. We ask them, did you hire veterans? Did you hire people who are on welfare today? And because those are the people eligible to that. And if they're felons, come out of jail and you hire them, you qualify for these credit, right? I have 3 examples for you. For another example would be your disabled access credit. This is tax credit as well, but I want to point it out that it's not just the welfare ramp qualifies for that. Everything you do to help the disabled people qualifies. I'll give you an example. And the desk you have to make it different. You bought a new furniture for the person on wheelchair, or you bought a new furniture for the person who couldn't bend their knees or whatever. So these are the qualification. Of course, too big of a business doesn't qualify for that. This is only eligible for $1 million total sales and under, and 30 full-time employees and under, kind of small business. So all the small businesses, you qualify for that. And maybe you know, if you are actually need to provide the material for the deaf people, or for people who can't see really clear, you have to print things big, or you have audio versions of anything you do to help the disabled people. You don't have to identify who is that person you help. The action you took, as long as that action you took, it is geared towards to help disabled people, that is the credit applies to you. And that credit is 50% of up to $10,000 eligible expenses. So we're talking about $5,000 tax credit. So if you have to pay $5,000 taxes, suddenly it wiped out because you have the disabled access tax credit. The other tax credit, I was actually thinking in my head, this is the small business health premium tax credit. So what that does is, if you have less than 25 full-time employee, and if your average salary is less than $56,000 per person, okay? And if they are full-time and you pay for more than 50% of their premium, and you are eligible for that credit. So this is 50% of the cost you paid. So what if you are a S corporation and you are the only person working there? You pay yourself less than $56,000, and you have less than 25 full-time employee, and you pay for 100% of that premium. And those are the things that you could think of to have a credit to relate it to that. So if your premium for the year is $20,000, 50% of the $20,000 would be your tax credit. Just think about that, right? So I know I used S corporation right here. S corporation owners actually have a different way to deduct your medical premium. So maybe a better example would be if you have a one person, maybe it is another person in your company and you paid for the health insurance, then that person is qualified for that 50% of everything you paid for that person. All right, so with that said, I am giving you a reason why accounting need to be right, because we need to document how you paid for the premium. We need to know the total premium amount, so your accounting need to be there in order the tax people, when they look at your financials, they will be like, oh yeah, medical insurance premium, we need to apply for the tax credit. Oh yes, this is the felon person coming to work for this company. This is the salary we have. We need to apply for that. Oh yes, there is a audio version of the company website that is for disabled person, or disabled person to get onto the website. They can hear everything. So with that said, and this is qualified for the disabled tax credit. So all of these need to be on the accounting record in order you tax preparer to know what to do for you, right? So accounting, tax planning, why I say it is important, because that's falling into our three categories. Number one, tax structure. Number two, accounting method, and accounting itself. Number three is calendar year versus fiscal year. We pull this out because it is significant. And a lot of people, when you go to set up your company, that would never even come out as a question from your attorney's office, because they don't have to necessarily go down the route to plan your taxes. But the fiscal year versus calendar year is a huge deal for tax saving and the tax optimization, I would say. So calendar year, obviously we all know is January to December, right? Companies can go for January to December, and it doesn't have to go for January to December. It really depends, right? Now, I want to say that, some people would ask me, oh, okay, so tell me why fiscal year helps. So let me give you an example. The seasonal business are very much sometimes need to be in fiscal year. So for example, a construction company, okay? Construction in the Midwest area, I'm not talking about Texas or places that always hot all the time. But for Midwest area, the winter time is not really a outdoor construction company. If I have a concrete pouring company, they pour concrete for the foundation, they pretty much cannot do that from sometimes in late November to the middle of March. They just don't have much work during that time, because if you pour foundations during those winter time, the foundation quality is not the same. Okay, so with that said, and they have a seasonal, right? They're busy from beginning of April all the way to sometimes in November. So they made all the money in this period of time. So would that be really good? As soon as they wrap up a busy time, they start paying taxes. So let's say they are calendar year. So December come, they wrap it up and they paid all of their income they're generating for the year. They haven't really had any time to plan and spend from December 1st all the way to April. They didn't do that yet. So they just kind of make the money. So imagine you're doing that in the first year. Are you kidding me? You're going to be paying taxes left and right and then not having a chance to put in the expense. Am I right? So with that said, some of the company would make the fiscal year end not at the end of December, but at the end of March. Why? Because they began April, they end of March, they went through their real season. They went through their real year. Am I right? This is their economical year. This is the year that they had income, they spent it, so that's a complete cycle of the business. With that said, fiscal year is meant to match your cycle of business, but it starts with your making money, ends with your spending money. So same thing, if you have a specialty retailer, for example, you just sell, Christmas novelty for Christmas time. So you start buying your inventory, selling your inventory, and you have a season. So is that good enough for me to make your year end on December 31st of each year? That would be a little crazy, because you just sold all your money and now you're going to pay taxes. And then what happened for the rest of the year? You start purchasing, you start spending, you start making your retail store look better, and those expenses would have to wait for next year. You can't spend it. You're not really going for your real economical business cycle, right? So with that said, that is your consideration. It is something you want to always keep in mind when you start your business, making sure your economical cycle matches your calendar year or your fiscal year. Then of course you say that, well, I already got my business going and this is not good because I didn't really know that at all. No, not to worry, because you can always change it. You can change your business fiscal year. So what's going to end up is you're going to file a short year to come up with the month that between these two methods, you're going to have some month that you need to report. We call them short year. And then you will go on with your proper business cycle. So with that said, I will go back to our cube, right? You remember our cube? And we had this tax planning areas that we want to focus on. One is the tax structure, the other one is accounting, and then the fiscal year. So when we have clients come to us for tax planning, and that is really how our mind is working. So we look at your structure to make sure it's still fit, and then we look at your accounting to make sure that it gives us all the information we can dig up to do those tax credit, to do these tax deductions for you. If your accounting doesn't support what we want to do on taxes, then you need to go back to get your accounting streamlined, right? So to get that done. This is where when you do accounting and in our firm, and then our tax team come in to do your taxes internally, and we already communicated with all of these credit that could ever be eligible to you, because that's what we do. And we have this checklist between accounting department to the tax department, and they will coordinating these credits, and your accounting will reflect exactly how we're going to do that for you. So in here, under accounting area, I mentioned about 4 things. Do you remember what that is? So accounting method, cash and accrual. And I also mentioned about the accounting need to be done for some of the tax credit. There's 3 tax credit on my slides. One is the work opportunity credit and disabled access tax credit and medical insurance premium tax credit. Earlier, I also talked about research and development credit. That is another one is going very hot and strong right now after the Inflation Act, and Biden administration actually did some changes to the R&D, made it more accessible to small business and to the business that doesn't make it. If you have a lot of payroll but you don't have profit, and then you could get R&D tax credit from your payroll tax as well. Those are the things as a business owner, just tie yourself with a firm that really knows what they're doing. Community CPA is that firm. We spend a lot of money to train our staff. We spend a lot of time to do research to get the most relevant items for you. It is almost like we're going out to shop for those tax deductions, tax credit constantly for you, just because it does change. It is, tax world, accounting world changes every day. Every day is exaggeration. That's how we feel. Just because sometimes the rule changes. For example, Inflation Act changed August last year, right? Coming in August last year. But interpretation of that particular act comes every day. You have a different trade associations, AICPAs, they interpreted that for accountant. Then you have National Tax Association, they interpret for taxes. So there's so many interpretations according to the act that was published by the Congress, but it is really something that based on the interpretation, we will digest whether that is fit for the small business, which interpretation is beneficial for the small business. There's just a lot of that in the background happening in our firm that doesn't happen when you don't tie yourself to the capable professional companies. And one person shop, small tax preparer shop, it is just not enough for businesses that is already taking off. And that's why our firm, we are very focused on growing companies. If you are growing, you felt like you're paying too much taxes, you actually should be here with us, because we are the firm that can help you. So that kind of, my last slide is, are there any other consideration? Of course, a lot more. Even on the accounting method, you have mark to market, you have inventory with all kind of accounting method. There's just endless topics in there. But you as a business owner, you don't have to understand, know all of it. All I want you to remember is when you do tax planning, you want to touch your tax structure, you want to know your accounting, you want to know your fiscal year or calendar year, why you are that way. As long as you have these 3 things in your mind, you are already our client, because that is how we educate our clients to know what to ask when they get out there. And one other principle we have in our firm is that we don't do tax planning, tax strategy for you if you don't understand it. So obviously everybody has a different take on that. So if our methodology is too above you, you felt dizzy and you couldn't really handle, feel very anxious for that, then that's not for you. And we designed a simplified version for you, so we cater your understanding, and we give you the tax saving techniques and the tricks and the means to you just based on your understanding. And the one last thing in our firm, we actually making sure that everything we give you, it is properly vetted through the system, through our understanding, and we reference to what we understand. So everything you got from us is solid. It is not somebody's a dream from last night. It is somebody's study from the materials that we have and for our profession. With that said, you can always email Catherine at communitycpa.com for what you want to get from us. We will always be here on Saturday at this time to give you the knowledge we know. And obviously, we want to make the knowledge very accessible to you. So there's no jargons, there's no hard concept. We just want to hand over to you like a place of cheesecake. So you just love it. With that said, one last thing I want to impress you with is our office hours. We open Monday to Saturday, and 8:30 to 5:30. So our office is always open. If you are the busy entrepreneurs and you don't have time Monday to Friday and Saturday, we are here. And just give us a call and set up appointment coming in on Saturday, and we're here for you. I'll talk to you soon. Bye-bye.